Welcome everyone to the R.C. Thornton and Associates webinar. Today we are talking about cost segregation. If you own a building or have a business, you will be excited to learn about the tax savings of cost segregation, which we will be discussing today. Let's change slides. First, I would like to start off by thanking and introducing our sponsor, Colleen Manley. Colleen, thank you very much for sponsoring this webinar. Would you please share with us a little about you and your organization?
Thanks, Kit. I appreciate it, and Chuck, too. We have a unique wealth preservation preventive law strategy, which includes serving a bit in the general counsel capacity, whereas we practice and help our clients in the areas of law that we're good at. But I'm always looking for new ideas and new anything that might be help our clients in other practice areas. And so I'm happy to be able to share this cost segregation concept with clients and friends. Thanks, Kit. I'll give it to you now. Go ahead. And Chuck I've known Chuck since I first started practicing law. He has been and still is a mentor to me. He was very, very good friends of my father, and has more. Obviously, I don't know anyone that has more letters behind his name, and he always seems to be 3 or 4 steps ahead of everyone else that I know, or many people I know in accounting. And so I was just thrilled when I had lunch with him, and he was discussing this new it's actually been around. I couldn't believe it. It's been around a long time, and I hadn't heard about it. And so I was a bit shocked about it, and thought that this would be maybe other clients and friends and people were in the dark in this area, and it really provides a lot of benefits. So, Kit, I'll turn it over to you and Chuck, because I think that's what the meat of the program will be. Thank you so much. I appreciate it.
All right, Chuck, we'll let you start the presentation.
Okay, well, welcome. This is Chuck Thornton, and by the way, even the Wall Street Journal says that what we're going to talk about is a lucrative tax strategy that if you have a building, a commercial building, you ought to be using this. Now, when I say commercial building, I don't mean your home. I mean a commercial building that you might be renting to some outside third party, or it might be a building that you're renting to your own business, which is typically the process that we see. So let's take a look at the next slide here. Now, I haven't really gotten into what cost segregation is because I want to kind of whet your appetite a little bit. These are real cases here where we were dealing with people who had never used this thing called cost segregation. And so what we did is we did our accounting stuff to be able to do this cost segregation, went through all the different minefields to figure out how to get the deduction. And here's just some ranges: a wholesale distributor, $125, a dentist sole practitioner, $82,000. A major medical group that had a reasonably large building they bought 2 years ago, $229,000. And we just finished another one. It was around $330,000. It was a manufacturer that basically had a building for a couple of years. Now, some of these were large, some of them not as large, but even this dentist sole practitioner, $82,000 is, remember, that's after taxes. That's a real savings that you're getting there. So what do these guys do with their businesses? What do these guys and gals do with their businesses? Well, most of them, quite frankly, retain the money in their business for growth. But I have to confess, one did purchase a very nice vacation home. So the money's yours. You can do what you want to with it. You don't need to give it to the IRS. So what is cost segregation? Now, I'm going to be boring here for a moment. I'm going to try not to be boring, but I'm going to use this word called depreciation. It's a write-off of your building over a period of time. Everyone in business, anyone who owns real estate, knows there's something called depreciation. What we're trying to do is we're trying to get depreciation fast and upfront, fast and furious, so we can get a lot of tax savings currently. You can see our happy guy down at the bottom there with that cell phone driving his car. I wonder if he did a cost segregation. So it gets exciting. So what is it? Why do you care? I'm going to be a little technical. It'll make sense. Hang in there with me. I'll try not to talk to you like you're an accountant, but this helps understand the logic behind it. It almost helps you kind of sense whether you might be a candidate for it. What's depreciation? It's just a charge. You know, you're just taking a building and you're taking a number of years that it would last, and you're writing it off over a period of time. A $500,000 building, let's not call it building, just $500,000 whatever, divided by 20 years would be $25,000 a year. Now, by the way, buildings are written off over 39 years, commercial real estate over 39 years, so that 25,000 is a lot less. Nice deduction, but I think I'd like to have more deduction. How about you? Systematic means that we could, in effect, take that $500,000, and depending on what the depreciation rules were for that current year, I might get 1/2 of it in the front year and then get 1/5 of the remaining of it. And I get a $300,000 deduction in 1 year compared to $25,000. So which deduction would you like to have? So here's what the typical accountant does. Quite frankly, years ago, this is what we were doing before we got involved in cost seg. By the way, cost segregation, you notice that Wall Street Journal quote? That was 2003. This has actually been around since 2001, and there's a historical comment where it came from, but this has been sanctioned. There's a ruling on this. This is not an aggressive tax strategy that anyone's coming up with. But typically what accountants do, they'll take 80% of the cost of the building, they'll say 20% is for land, 80% is the building, they'll take it over 39 years, and that's it. Or they might be a little more proactive. They might break out some landscaping, a few other things, and they might do their own little desktop cost segregation. But a real cost segregation study goes well beyond this. So if you've had a building for a couple of years and your accountant or your other advisors haven't said, what do you think about cost seg? Should we look into it? Chances are they're not involved in the cost seg. Chances are they're doing what are those first two bullets. You might save hundreds of thousands of dollars with cost seg. Okay, depreciation could be deducted under a cost segregation approach if used properly. Here's just an example, real example, rounded numbers, building cost $2 million, I'm forgetting about the land. Typically it's written off over 39 years versus it's not uncommon that you can get more rapid write-off on 25% of the property. The additional first year depreciation is $300,000. That's the additional over just taking over 39 years, the additional depreciation you get from cost seg with the cash flow savings of $120,000. You can see it's not hard to get those numbers that I was talking about on that first slide that we looked at. Next slide, please. So how do you do this? Be a little technical, hang in there with me. I promise this is all going somewhere for you. The trick in it is what's called personal property, tangible personal property. And for tax law, it's called 1245. Here's the key. Section 1245 probably means nothing to you, but what I want the takeaway to be is this. The definition of tangible personal property for tax purposes is not the same as the definition under local law. So what happens is everyone says, oh, under local law, this is all real estate. We have to take it over 39 years. But for tax purposes, you can break out some 1245, which is the tax definition of tangible personal property. And that's where about 25% of the cost of your building often can be reclassified as Section 1245, which is tangible personal property for tax purposes, and depreciation is faster. Sometimes in some years, depending on what year you're talking about, you can write off the whole amount in the first year. Sometimes you can write off a half. Sometimes you write over 5 years versus the 39. The majority of accountants fail to take faster depreciation. In most cases, they only depreciate over 39 years. So what is 1245 property? Getting a little technical here, but you can see how the lingo is going to work. Is property subject to depreciation. It's not inherently a permanent structure, or it's property used as an integral part of the manufacturing or production. As an example, a manufacturer may have power lines, special lighting, and things like that, all embedded within the real estate, but it could be 1245 property. Here's just a couple examples of ones that we've seen in cost segregation studies. Electrical outlets, specifically associated with items of machinery and equipment, decorative rock not functioning as part of the building, floor covering, sheet vinyl carpeting, decorative light fixtures, decorative carpeting, strippable wallpaper. In fact, as I walk by buildings nowadays, I look at them and I start saying to myself, I wonder how much of this could be written off over a short period of time. Even paint booth in a fabrication facility could be an example. So the thing of it is now we all know what we want to do is when we buy real estate, we basically want to be able to call as much of this as tangible personal property as defined for tax purposes as possible. And if we had not taken the cost segregation over the last 5 or 8 years, I'll let you know right now the secret is you can take all that lost appreciation and you can do it all in the current year. So this is not lost just because you didn't do an allocation the year that you bought the building. You can always catch it up, which is a bonanza. So, but since you and I know that we really want to call real estate as much tangible property as possible, do you think that maybe the IRS knows that that's what we're up to also? So the question of it is, how are you going to defend your allocation with the IRS? And the last method is a rule of thumb. It's a guess. A lot of people use this. They say, well, I guess the depreciation for leasehold improvements would be this, for lights and so on. It's a guess. But we've actually studied the Internal Revenue Manual, which is the audit guide that the IRS uses for these, and they warn the auditors, view this caution since it lacks sufficient documentation to support the allocation. They basically say, view this with suspicion. So someone who's just making up the numbers based on a guess probably will not be successful. And remember, the burden of proof on proving this allocation is with you. You are guilty until you prove you're innocent as far as your allocations are concerned. The Internal Revenue Manual discusses different ways of doing this. Now, you're ultimately going to see that someone needs to do a cost seg, and we're going to talk about who does these things. It's a report, is what happens. Someone comes in and does these studies, and they say, here's how things are going to be broken down. They use certain software, they use different standards, they use contractor estimators, different things to come up with a report that says, based on all this, this is the breakdown. That's only part of the story. In actuality, that's the easy part of the whole thing. The real question is should you do this to begin with? When should you do it? How do you stage it out? How do you arrange your tax return with income and expenses elsewhere so as to maximize the results? It's possible you could do this and you kick in something called an alternative minimum tax. Now, the people doing your cost seg study, that's not their job. They just give you the report. You have questions about what type of entities. What limitations do you have? What's called basis net risk, and if you're following that as terminology, you're doing pretty good. But there are issues that face on your tax return that have nothing to do with the cost seg study that could stop the benefit of this if not handled right. There's elections to use. What year do you do this? And sometimes this can work so good, so well, that you actually get too many deductions in 1 year, thereby losing some of the tax benefit. So next slide, please. So first of all, you want to make sure you select a company that does cost seg studies. And you do it with care and competent advice because, remember, the burden of proof is on you, not them. Oh, yes, if they did a bad job, you might have some recourse against them. But the IRS has nothing to do with that. There is no restrictions on the IRS. Almost anyone purportedly could do a cost seg study, referred to as a study, and sometimes anybody does. Here's the challenge for you. Google cost segregation. I did. Over 3 million results. Google cost segregation provider yields 200 results. I have rounded here, but look at the quantity of people that they say they are cost segregation provider. I mean, that's like, what, 4,000 per state? That's quite a bit. Do you think the IRS knows there's a lot of people out there who purportedly do these cost seg studies, but who has the burden of proof? You do. So select a company to do your cost segregation study with care and competent advice. Questions to ask: do you guys use a rule of thumb? As soon as I say sure, stay away. How factually intensive are the reports? Are they supported by corroborating evidence? Now, you or your accountant could take a look at sample reports. And are the cost segregation companies personal and confident in design, construction, auditing, and estimating procedures relating to construction? What is their background? Just because someone is a CPA doesn't necessarily mean that they know how to do a cost seg study. Just because someone is a construction foreman doesn't mean that either. And again, I'm giving you a few sources here as to what the IRS looks for to see whether someone is actually competent. Next slide, please. Buyers of cost segregation sometimes will find you. They'll just contact you. Most of them are not CPAs, nor do most of them have to be CPAs. I'm not endorsing that you have to be a CPA to do this. But one thing's for sure, they don't know your situation. And very quickly, if they are good, they'll tell you, you really do need to get some analysis from your CPA or tax advisor as to whether this makes sense, because they're really in no position to analyze your situation. And nor can they or will they provide a candid assessment of your needs for use of a study. If they do, without actually getting into all of your tax returns, I'd be concerned about that too. So that puts you to who should be your tax advisor to determine whether you have a good quality provider of cost segregation studies, and does it make sense to you? Remember that slide? Alternative minimum tax, bases at risk limitations, too many deductions. You don't want to go do these studies and incur the cost, only to find out that you got to the gate but you can't get through because of these different limitations. So when you talk to a tax advisor, have they been involved extensively with the use of cost segregation studies? Do they know what the criteria that should be used in the selection of cost segregation company? Are they familiar and have they read the audit guide? So here's some results again, and I'm going to share with you what the investment was in this, just so you can get an idea of cost-benefit results. This wholesale distributor basically had one report done. The report was around $7,000. After tax cost on that probably is about $4,800, and so they got a $125,000 after-tax rate of return for $4,800 after-tax cost of the cost seg study. I don't even have to do the mathematics. That is a tremendous rate of return on their investment. Let's say we had an internet local retail provider. Now that particular individual had 3 buildings. We staged this in over a 2-year period of time. That was an example where all these deductions 1 year is going to cause loss deductions. They were able to get that for about $18,000 after taxes, probably around $12,000, $13,000 in net after tax cost. And they got a $225,000 tax-free, in other words, it's after-tax return. You don't have to do the math. That's better than anything you're going to get in the stock market anywhere at all. As long as you're using a good cost segregation provider, you're following the process. This has been sanctioned since the year $2,000. Remember I said one person purchased a nice home. So are you ready for this? So, do CPAs generally advise on cost segregation studies? The theme is we do, okay? But do others do it? Some undoubtedly do. We're not the only CPAs in town, I'm sure, that understand how cost segregation studies work and what the implications are. But we do believe, however, that most do not have and have little knowledge in this area because it takes quite a bit of a study of the manual. It takes a lot of study of flowing through these issues and reading regulations as to how you're going to tie all this together with the knowledgeable regulations. So we believe that few really have the extensive knowledge in this specialty and the discovery and relevance of timing and whether you even need a study. Remember, these mostly originate from the cost segregation provider approaching you. We approach our clients, but that's because we're involved in this. So does R.C. Thornton Associates do cost segregation studies? Well, you're probably starting to figure out, no, we don't. We don't do the studies. Why don't we do the studies? We think that people who do studies full-time, that's their discipline, they have contractors, they have contractor supervisors, and there's specific software that they're required to be using for the cost segregation studies. They are much better suited than we are as a CPA firm, and most likely any other CPA firm unless that CPA firm has dedicated themselves to bringing these people in-house, which does happen once in a while. So although there is no specific requirement by the IRS who does this, we feel, as many others do, this is a discipline better suited to engineers, architects, construction-related, familiar, and cost. And also, too, you want to make sure that those people have a good understanding of the Internal Revenue Audit Guideline on what is an acceptable study. So, with that said and done, why are we doing this? Because how can we help you? We're the second tier. The first tier of getting the report, quite frankly, is the easy part of this whole process. It's actually the most expensive part, too. But again, without having the guidance on this process, making the determination whether you should have one, going through your numbers, asking questions about all these things called basis at risk limitations, elections and things like that, any wrong move can take a wonderful cost study and totally waste the efficiency of the deductions. Do you have a unique situation? We can help you with the selection even of your cost segregation provider. We're independent. We have no bone to pick with anyone that is cost segregation. Cost segregation people are not going to refer us any business back. They're not going to buy us lunch or anything at all. We are truly independent. We can help you properly implement this on your tax return. Not only do you have to determine whether this makes sense, you have to make sure you flow it all the way through on your returns correctly and make all appropriate elections that need to be taken. We have worked on many cases with our clients over the years that has ensured solid results, and as you can see just from our sample, hundreds of thousands of dollars of tax savings, often all in 1 year. Next slide, please. So if you would like to get more information on how we can help, there's my email, chuck@rcthornton.com. Please identify when you call. Let me know that, hey, we were part of the Colleen Manley group. There's our website if you'd like to take a little bit more information. And I think, Kit, is this the point where I turn it back over to you?
Yes, thank you, Chuck. Thank you very much. I'd like to also thank our sponsor, Colleen Manley of Goodson Manley Law and Legacies. We really appreciate her help and collaboration on this webinar. Again, if you'd like to reach Chuck, he is available via email. And if you want any further information or details about this presentation or other presentations, send me an email at info@rcthornton.com. So at this time, I will turn off the recording